Ever felt like fate brings you down just when things are looking up? It's like the world has a twisted sense of humor. As we recover from the pandemic, another crisis looms, threatening chaos.
A rough week for the banking industry.
The collapse of Silicon Valley Bank is causing shock.
The second biggest bank collapse in U.S. history.
The U.S. economy is shaky and worse than inflation is coming.
Federal Reserve is raising the
Fed
interest
is
rate
set to raise interest rates.
Highest inflation in 40 years.
Silicon Valley and Signature Bank's collapse sent shockwaves, leaving everyone wondering what's next.
As of this morning, Silicon Valley Bank, or SVB, has gone under completely.
It is the epicenter of tech startups, venture capital.
The American banking system is really safe and well capitalized.
There will be another financial crisis. Of course, when the crash comes, the big banks will throw up their hands and say, it's not their fault. Nobody could have seen it coming. And then they'll run to Congress and beg for bailout money.
So if you're unprepared for a global financial collapse, brace yourselves. Silicon Valley Bank was a renowned financial institution with a reputation for partnering with some of the most influential tech giants in the world. It was a powerhouse in the industry, focusing on backing healthcare companies and technology startups. However, this all changed when the bank suddenly collapsed, sending shockwaves through the financial system. This significant collapse was the largest bank failure since the 2008 financial crisis. Its clients were spooked and began to rush to withdraw their funds. The panic was not limited to Silicon Valley Bank's clients, but soon spread to other financial institutions, such as Signature Bank, causing a domino effect that would further worsen the situation. This situation has prompted a widespread panic, with people across Washington and Wall Street scrambling to find a safety net. There's a growing fear that traditional banking is no longer safe, and many are exploring alternative options. This collapse is troubling because it occurred while the world was already grappling with the economic fallout of the pandemic. The federal government raised interest rates to cope with high inflation, but Silicon Valley Bank failed to take preventative measures. The bank's low interest rate policies had led to profits for decades, but once considered sound, its investments became its downfall. The Federal Reserve's increased interest rates only fueled customers' fears, and they became increasingly concerned about losing their money. This prompted many investors to withdraw their funds, ultimately destabilizing the bank's balance sheet and leading to its eventual collapse. After 40 years of operation, Silicon Valley Bank was forced to reveal its unstable state and the need for $2 billion to stabilize its balance sheet. Unfortunately, this loss caused many investors and clients to withdraw their money, exacerbating the dire situation. The financial crisis caused by the collapse of Silicon Valley Bank and Signature Bank has led to panic among customers and affected regional and state banks. The chain reaction resulting from these significant banks facing heavy losses has sent shockwaves through the financial industry, causing widespread concern about the stability of banks. As news of the bank failures spread on social media, customers of regional and state banks began to worry about the safety of their deposits. As a result, they demanded withdrawals to move their money to larger, more established institutions. This sudden surge in withdrawals has left many smaller banks scrambling to meet the demands of their worried customers. To keep up with the cash demand, many state banks have had to take out loans to ensure they have enough money. For instance, First Republic Bank had to borrow $70 billion from JP Morgan Chase to remain solvent. However, this has led to many banks accumulating debt as they try to meet their customers' needs. Customers are understandably questioning whether they should withdraw all of their money from their accounts. However, this decision is more complex than it may appear. Customers should consider the implications of withdrawing their money, as it may cause more harm than good. For example, withdrawing all of your money from your bank account may affect your bank and the broader economy. This can lead to an economic domino effect that could cause widespread panic and instability. Furthermore, if too many customers withdraw their funds, the bank may become insolvent, and the FDIC may be unable to cover all of the deposits, exacerbating the dire situation. The collapse of Silicon Valley Bank has raised concerns about the banking industry's stability. Following the destruction, the FDIC took control of the bank and is now responsible for over $175 billion of customer deposits. This move has been seen as a protective measure, as the FDIC was established to protect depositors in case of a bank failure. However, the fact that the FDIC only insures deposits up to $250,000 has caused panic amongst corporations. with deposits totaling billions of dollars in Silicon Valley and Signature Bank. The banking industry has struggled to regain public trust after the 2008 financial crisis. As a result, protective policies were implemented to prevent a similar collapse. The general hope is that the FDIC's takeover of Silicon Valley Bank will bring stability. However, the situation is still uncertain, and the fear of a 2008-like crisis looms over the industry. While small and mid-sized banks have been reassuring customers of their financial stability, the reality is that several banks have taken out loans totaling $153 billion from the federal government. This has led to concerns about the overall health of the banking system, and customers are turning to larger institutions to protect their money. In this situation, individuals need to double-check the status of their bank and keep an eye on funding statements to ensure that their deposits are secure. Of course, they are safe if deposits are under $250,000, and the bank is federally insured. However, the uncertainty of the situation has led many to question the banking industry's stability. Looking back to the 2008 financial crisis, we recall that mortgages primarily caused it. Banks lent money to homeowners, and the public's funds were debt obligations to protect the banks from any potential risk. As the banks began to struggle, many industries were impacted, and the housing market declined, causing further damage. However, the government intervened and implemented new regulations and rules to prevent another crisis. In addition, the Federal Reserve has been closely monitoring the banking system to prevent further damage. While there may be some similarities to prevent financial problems, we can confirm that the 2008 crisis is not repeating itself. President Biden has reassured the public that the financial system will remain stable and deposits will be accessible.
Rest assured they'll be protected and they'll have access to their money as of today.
Jay Hatfield, CEO of Infrastructure Capital Advisors, has stated that it does not make sense to withdraw all of your money from the bank if the FDIC protects your deposits. Your money is secure in such situations, and you do not have to worry about losing your deposits. However, not all bank deposits are insured, and those with uninsured deposits who bank with institutions that do not comply with federal regulations should be cautious. Bankrate analysts have warned off the potential risks in such situations. The Secretary of the Treasury has offered reassurance that the government will address the crisis. The strict regulations have helped manage the problem, and the financial system will soon regain stability. Even foreign financial regulators believe that the US government has taken the necessary measures to prevent further issues. This crisis serves as a reminder of the importance of reducing strain on the banking system. The public should avoid bank runs and sudden deposits to overcome the situation. Unfortunately, such actions only add to the panic, causing banks to take out loans to meet customers' demands, worsening the situation. Therefore, it's essential to remain calm and not make hasty financial decisions. Inevitably, this situation won't be resolved anytime soon, so stay informed by keeping in touch with us for regular updates. The collapse of Silicon Valley Bank has left everyone uneasy, and if you're looking for more information, be sure to watch our video titled "The Stunning Downfall of Silicon Valley Bank."